Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
Matt, today we are talking market valuation.
Does it get more exciting than this? I mean, market valuation. People love this stuff.
They absolutely love market valuation. And unfortunately, we're going to rain on their parade a little bit as we go through the episode, because people love to talk about market valuation. People love to think that market valuation is this huge driver of a lot of what goes on. But unfortunately for many of us, it doesn't work out the way we thought it might work.
Not only does it not work out the way you think it might work, it's a useful ruler to be aware of, and it really helps in portfolio construction and financial planning and expectation setting for longer time horizons. I'm a believer in all that stuff. But as far as just like even going through some of the prep for recording this, you're just mind-blowing stuff. You're just like, this all runs so counter to how we normally think, which is why it's important to do an episode and talk about this stuff.
Yeah, and it's like anything in investing. You just have to understand how it works, why it works, and what it's for. And a lot of times that's what people get wrong about market valuation. It's not that it has no impact or it doesn't matter. I mean, obviously a world where market valuation is irrelevant to an infinite time frame is not a great place we want to be in. We want people to care about the fundamentals of individual companies and the fundamentals of the market. It's just sometimes that time frame that it works over gets, people can get that crossed up, and we'll get into that later. But first, obviously, now that we've told people that market valuation is not that useful, the first thing we need to do is go through the market valuation. That only makes sense, right?
Yeah, I think let's do at least a high level overview of some of everybody's favorite valuation metrics, adorable as they may be, and at least set the table for digging in a little bit. So start us off. What's current market valuation? Let's just pick on the good old S&P 500. Where are we at with the numbers we know and I guess can trust? The trailing 12-month PE. Where's the S&P sit here on May 30th, 2024? AD.
So what's interesting about this, it's not necessarily, and we'll get into what the valuation is. It's not necessarily what the valuation is. It's also like how the valuation is calculated, because you'll see so many different market valuations out there. And it's just like inflation numbers. It's like anything, anybody who has a case they want to make will find a market valuation indicator to help them make that case. And it's the same thing, people who think inflation is going to rage out of control have numbers. They can slice and dice the CPI and get to that. If they think inflation's, already below 2%, they slice and dice it and get there. And it's the same thing with valuation. You'll see as we go through this, different ways of looking at valuation lead to different conclusions. And the first thing here is, we're just looking at the S&P 500's PE ratio. And, what you probably will see from this chart is it's high relative to history. You can see the mean of history is 16% or 16 in general. The median is 15 and we're at 27 right now. So we are very high relative to history. And you can see also in this chart, if you look at the beginning period, if you were to cut this chart in half, the average valuation, the median, the mean, whatever it is, in the first half of the chart is much lower than the second half of the chart. And that's something we'll see in a lot of these metrics. And that's something people debate right now, which is this idea of, do we deserve a higher valuation? So the fact that it's high, maybe it's not as bad as people think, because, we deserve a higher valuation. Technology has changed. The market has changed. Things are a lot better than they used to be. So maybe this high valuation is justified. But in general, clearly, if you look at a long-term chart of the S&P 500's PE ratio, it's high right now relative to history.
Super, super basic, but I think a super, super important point whenever we talk about this stuff is we're talking about a ratio, which means we're talking about fractions. And as I can attest, hopefully past the period where it counts, I had a misspelled version of my own last name for a fourth grade teacher who taught me fractions. And this is the first time I ran into like the full brick wall in school and have a lifelong fear of things like, actually, I should say fear and respect for fractions because of this fourth grade math teacher that I had. When we look at stuff like this, we have to remember it's a fraction. So when we talk about the PE ratio being at 27.37, love taking it out 2 decimal places, by the way, really, really helps. Shows the sense of humor in these things. This idea that we're making both an assessment on what's going on in that numerator and the denominator I need this for myself. I need to anchor back to a reminder that there's an actual difference in the numerator and the denominator and the relationship between the two. So funny things happen here. Walk me through for a second, Jack. What's in the numerator? What's in the denominator? I know this is fourth grade stuff, but let's just say this out loud before we work through the rest of these.
Yeah, well, PE ratio. So the numerator is just the price at any given time, which obviously changes all the time, changes every day. And then earnings is the denominator. Typically, and again, we'll get into this when we look at other stuff, typically trailing 12 months earnings, which is earnings in the previous 12 months. But it's really important to keep in mind, we could also look at forward earnings for the current fiscal year. We could look at forward earnings for the next fiscal year. We could do the CAPE or something, which we're going to do in a second, where we average out a bunch of earnings. So really the numerator is very simple. The denominator can be all kinds of stuff. And as we'll get through this, we'll see as we change that denominator and we look at different things, we can get very different conclusions or very different numbers.
That idea that as you swap out the denominator, you get different numbers is the heart of understanding the narrative construction and presentation of these things when they're used. And it's also the idea where every time you see a giant spike on this chart, and there's a number of these times where you see these giant spikes, in every one of those cases, that's because price has typically run away from wherever the earnings baseline is in that last 12-month window. Part of the reason these things tend to suck as a timing tool is because of these gaps. So seeing that gap in the, I'm assuming that's the financial crisis or right before it when we broke through the top of the chart.
That is correct, yes.
Yeah. You can see how narrow and peaky that thing is. And it's so narrow and peaky because earnings, correct me if I'm wrong, since I can't see exactly when that thing starts, but that's because basically earnings fall off a cliff before price, or price goes through the race before
earnings. In that case, there was just an outlier in terms of earnings. In 2008, earnings fell off a cliff. But what's interesting about that is, that was not a sign that you should be panicked because the market has a huge valuation. It was the opposite of that. That huge peak occurs at the beginning of 2009 when we're getting 2008 reported earnings, and those 2008 reported earnings are terrible. But that was clearly not a time you should be selling because of valuation.
Yeah, if anything, it's actually giving you the opposite signal, which is why I know it's a fourth grade math point, but this idea of every ratio is a numerator and denominator, you should be asking the question about what's in each and what it's giving to you right now. Distinct memories of that early March 2009 market bottoming period and seeing some of the valuation arguments and going oh my God, this thing is woefully wrong. I'm going to butcher it, and maybe you remember it, maybe you don't. Is it the Molodovsky effect?
That I don't know.
There's some crazy stock research thing. I should have looked this up beforehand. It's this idea. And I think it's usually used to describe cyclical companies. And it's this concept that basically very cyclical companies with very quirky earnings cycles will almost always say you buy them when the valuations look high and you sell them when the valuations look low because you're allowing for this catch up. So S&P 500, congratulations. On a trailing 12-month basis, you're rich according to history, but that could change really fast if earnings accelerated. That could change really fast if the price went off a cliff. Wonderfully useful. What do we got next?
Yeah, well, this next thing is going to kind of get rid of that problem you just talked about, which is this idea that, earnings plummeted in 2008. So the valuation went off the charts, just a quick spike and came right back down. This is the Shiller PE ratio, which is using 10-year average earnings in the denominator. And the idea is it smooths things out over time. So, when you only have one data point in the denominator, you can get some of those weird things going on. This is trying to smooth things out over time. And you'll see this is, we had, if you look at the peaks on here, obviously the .com bubble is the 45. You see there, which the previous high had been just north of 30 back in the 1920s. And then we got hit 45 before, and now we're at 34. So we're not at .com levels, but we're above anything that had happened prior to then. So it shows the same picture. I mean, the S&P 500 is expensive. Now, it's important to keep in mind when we're talking about the S&P 500, we are talking about large companies, and we are talking about the biggest companies having the biggest impact. So the valuation of Microsoft is much more important to this overall valuation than the valuation of company 500. This is not some equal thing. And it shouldn't be some equal thing because Microsoft contributes way more earnings to the S&P 500 than that bottom company does. So Microsoft's valuation should matter a lot more. So that's it's just important to understand this, because when we get into these debates people have about like, well, the valuation of the biggest stocks relative to the valuation of everything else, like this is being driven largely by the valuation of the biggest stocks. And this is showing that although there are 500 companies in there, this is showing that the biggest stocks are expensive right now.
Numerator, denominator, price on top. When we talked about the trailing 12-month PE and now the Shiller PE, we are talking about market capitalization weighted as the price signal, because I can't think of another word to use for it. That means that not only are we taking the price of the index, but we're also taking things like Microsoft and NVIDIA and Apple and those biggest companies and disproportionately weighting them. I mean, proportionate to theoretically the earnings in the denominator here, but we are looking at that through the lens of the biggest companies having the biggest impact on this stuff, which also gets into a little bit of a mind bend when you look at the largest portions of the market capitalization weighted index relative to their earnings contribution to said index. That I think helps explain some of the tech bubble bananas that we see in this chart. But again, numerators and denominators, it's just so friggin' important here. And even that point, especially as we get into this. So we're rich on a Shiller PE ratio to 10 years. So what about if, let's zoom back out again. We covered trailing 12. We covered Shiller. What about the median stock? If we split this down the middle, what's actually going on with median stock, trailing 12 months, earnings per share?
Yeah, so this is interesting. So this is not, again, this is not representative of the market, because like I said before, Microsoft is far more important for the market than some random smaller company. But for us as an investment manager, we like to look at this because we're selecting from a universe of all stocks. We are not market cap weighting those positions. So for us, we like to see like, what are the valuations out there in that universe of stocks we select from? And so what this is using is a median. So this is basically taking all companies, sorting them by their PE ratio, and then just taking the company that sits in the middle. That basically is more representative of kind of your average stock that's out there. What does their valuation look like right now? It doesn't tell us anything about what the valuation of the S&P 500 is. And so you'll see here, the current all stock, this is basically, it's right in the middle of where it's been. You know, we run our data back to 2005. So it's not as far back as the other data point, but since 2005, we're kind of right in the middle. This is not, the average stock is not crazy cheap. The average stock is not crazy expensive. You can see like in 2008, this got down to 10. So this got very low, but it paints a different picture. That other picture was very, very high overvaluation. This is kind of more a middle of the road thing. So it just gives us an idea that what it's telling us is not every stock is out there is expensive, like those most expensive stocks that most keep, or the most weighted in the S&P 500. Maybe there's some opportunities out there in some other stocks, if I look broader than it.
Do you want to venture to guess what Microsoft's, as basically one of the largest holdings here, what the trailing 12 PE is relative to this?
I don't even have a guess. I don't think Microsoft has that huge of a PE. I mean, some of those big tech stocks aren't that expensive. Maybe I'm wrong about that.
According to a quick search, it looks like it's 37 times as of May 2024.
Yeah.
But that's an interesting point when we start to compare and contrast. Microsoft as a substantial weight in the S&P 500 has, what is this, we're at 20 times on this chart, trailing
Yes,
12?
Correct.
Yeah, so Microsoft is orders of magnitude more expensive and dragging those numbers, so we saw in the other examples, higher. To your point, the median stock is not nearly as rich as some of the concentrated bigger names at the extremes of this one.
That's right. And also you have to keep in mind, I mean, obviously Microsoft is expensive to some degree for a reason. Microsoft's business is killing it. Like if you look at NVIDIA, like NVIDIA is very expensive too, but NVIDIA has like tripled their earnings or something, in just a few years. So, or at least doubled. So there's always two parts to this equation. Valuation is only one part of the equation of how we would look at, both the market as a whole and individual companies. The other part of the equation is, the growth and the future cash flows and like all that stuff that comes with the business. So this is only part of it, but these numbers, over certain timeframes can have some value. So it is interesting just to look at it. And the big takeaway here is, just that it is a different picture when you look at a broad universe that includes small cap stocks. I mean, our universe is probably about 2,700 right now. So a broad universe where we're kind of looking at everything equally has a very different valuation right now than a 500 stock large cap universe where we're counting the biggest companies the most.
Yeah, exactly. So now why don't you take us to take us from median stock into median earnings, and let's look forward, median forward earnings.
Yeah. So we're going to look at the median calculation again, but now getting back to your point before, of what you said about the denominator is really what matters. We're going to look at, instead of looking at trailing 12-month earnings, now we're going to look at what analysts are expecting for this year. So this is basically 2024 earnings, which is partially reported now and mostly is an analyst estimate. And so what picture does this paint relative to the other picture? It paints a little bit, a pretty similar picture. Stocks are a little bit, I guess they're a little bit cheaper here, but it paints a very similar picture. Where you get into these pictures being very, very different is when you start looking at individual companies. So like if you look at an individual company's valuation of trailing 12 months versus analyst estimates, you can get some really, really different numbers. In general, unless something crazy is going on where analysts have totally changed their estimates, for the market as a whole, it's not typically that different. And so we're getting a little bit of a different picture. But what's interesting is if we move on to my next chart, if we move on to price to sales here, now we're going to start to see a little bit of a different picture. Because what you have right now is you have a situation where margins are very high across the market. So companies have high profit margins. And so what that means is they're going to look better on a valuation relative to their earnings than they are relative to their sales. So in theory, they're getting rewarded for those higher margins with higher valuations based on sales. And so you'll see here, you see more overvaluation, even in the median stock. And you would see this too if we were looking at the market cap weighted indexes like the S&P 500. But when you look at sales, you're getting a little bit more of an overvaluation here than you were when we looked at it the other way. So none of these are, and we'll get into what this is useful for, but none of these are telling us, some major conclusion about what's going to happen in the next year or anything like that. But it's interesting to make the point that as we look at different metrics and as we change that denominator, as you said before, we're going to get different values, no matter what type of indicators we're looking at.
It's also really interesting in these cases, and we'll connect it back to some other financial planning topics, I'm sure, as we go, but just understanding how public, liquid, in many cases, well-capitalized with deep access to various parts of the financial markets, just to understand how these things are valued, especially back to business owners or other people too. Because this spread always exists in private markets. It feels historically a little extra chaotic in public markets right now. And even if we just think about on a price to sales basis, the idea that the median price, that's median price to sales, right? On this one?
Yes.
Yeah. So median price to sales on a trailing 12-month basis right now is like we're in the twos. This is not crazy. Companies like Microsoft, I'm not picking on Microsoft as a good or bad idea, but just to give you a dispersion idea, a giant company in the index is trading at over 13 times sales right now. Depending on the quality of the business, depending on the confidence in the results of the business, we see a really wide margin of the way things are being valued. And that's as indicative of the crazy stuff we're feeling in the times as anything else here.
Yeah, and it's interesting to think about, are we in different times now? Because if you ran, as a quant, if I run a strategy of 10 times sales plus companies, it's a catastrophe. The long-term returns of that type of thing when things get above 10 times sales is not good. But, you also have to argue, we are seeing different types of business models. We're seeing technology, enable companies to be more profitable. Maybe that won't be the case. Certainly in the run-up of some of these tech stocks, there were a bunch of times they were above 10 times sales and, they ended up doing really well. It was not any kind of negative indicator about their future. So as we debate all that's always, it's tough this time is different versus, the rules of the past apply. It's always an interesting debate to have, and you can have it around a lot of different metrics. And that's one you can have right now.
Especially when you consider like a Microsoft example where it looks like the way the numbers are coming in so far, you have 15% plus expected full year sales growth, 20% plus expected full year earnings growth. That probably looks a lot different from the median company and the experience right now too. Some of these big companies, to your point on NVIDIA a minute ago, are growing like gangbusters, and that's contributing to some of this dispersion we're seeing in the various valuation metrics.
That's right. And the question is, can they sustain it? And, that's for smarter people than you and me, probably.
Probably for you.
I don't know if you've been digging into their revenue to try to figure out if it's sustainable, but I mean, typically that kind of growth rate on that kind of size company has never happened before, but maybe it will be. You just don't know.
Well, nobody knows.
So
what about what is this good for? So we're talking about this stuff. We're talking about how messy this is, how clunky this data is, how convenient it is to take some of this data and paint a story around it saying stocks are super expensive, get out, or stocks are kind of cheap because of growth, get in. What's market valuation actually good for, Jack?
That's a good question. Before we do that too, I just want to show one more chart because I just think this is interesting. Like I always like showing stuff where the behind the scenes data matters a lot. So looking at this, so I just changed this chart briefly. One of the issues you have with a median. So if I'm calculating a median, what I'm doing is I'm ranking all the companies from cheapest to most expensive, and I'm taking the middle. Well, here's my problem, Matt. What do I do with, we have more companies than ever that don't make any money right now, that basically don't have a calculable PE ratio. What do I do with them? That becomes a challenge, right? How do I handle them? So there's two different ways you see this done. One is I just get rid of them. I just throw them out and I rank all the stocks that actually do have a PE ratio. The other way you can do it is you can treat them as bad. You can basically put them at the end, treat them as the most expensive stocks because they don't have a PE ratio. So the first way I showed you this chart, we were doing it the first way, which is we were just throwing out the companies, which is the way you most commonly see it done. We're just throwing out the companies that don't have a PE ratio. I'm not ranking companies if they don't have the variable I'm ranking on. This shows it the other way, which is this is taking the companies that don't have a PE ratio and it's putting them at the end and treating them as the most expensive. And so what that does is that makes the market more expensive in general. And it's just interesting to look at it this way. I just wanted to show this not that the conclusion, it does show the market is more expensive. Not to draw any conclusions based on it, but just to show how important it is when you're seeing data from people to understand what's going on behind the scenes in that data. Because that decision of what do I do with these companies that don't make money can completely change these types of calculations depending on how you do it. And if I had showed you trailing 12 months, you would see an even more extreme version of this. But it's just like that type of stuff is really important. And with all data is what's happening behind the scenes to calculate that data.
Back to the numerator and denominator piece. Like, yes, this is a fourth grade observation, but how often do we see one of these charts and actually pause to ask what is in the numerator, what is in the denominator, and why? If you want to tell a certain story, changing which data set you're drawing from, and if you're including or excluding profitable or non-profitable companies, including or excluding companies with sales, without sales, or, with earnings, without earnings, or even above like a threshold, these charts get sliced and diced a billion ways by people who want to tell a story with them. Stopping to ask what is in that numerator and denominator and why is one of the most important things you can do.
Right. What is in there and what is the incentive of the person that's putting it in front of me? Like those are always, if you can ask those two questions about any piece of data you get, you'll be in much better shape, because usually you'll find that the incentive of the person is completely tied to what's actually in the data. Because they have massaged the data in a way to make the point they're trying to make. And it's just important to keep that in mind when you analyze any kind of data about anything, not just about the PE ratio of the stock market.
As our friend Ben Hunt likes to say, why am I reading this now? Probably one of the most important questions we can ask. Let's go to this. I want to ask about what's this even good for? What's market valuation good for? Why do we even care at all if this is just such a PR campaign of stories that strategists want to tell? Why does this actually matter? And I do believe it actually does.
Yeah, I'm interested to get your thoughts on this. So I think for your average investor, in terms of how they adjust their investment strategy, the answer is almost zero. And I think the reason for that is it's important with data to understand the time frame the data has signal over. And with market valuation data, if I were to look at, I don't have the thing to put in front of us, but if I were to say how much does the valuation impact the forward 1 year return of the S&P 500 or of anything, the answer is almost none. There's almost zero correlation between what that valuation is and what happens in the next year. When you get to 3 years, it's a pretty similar picture. As you get out further into the future, if I want to see what's going to happen in the next 10 years, now valuation is becoming more of a signal to me. But the problem with that is, how does your average person judge their investment strategy? They judge their investment strategy over these 1-3 year periods. So if I'm making changes to my investment strategy based on valuation, I'm taking a signal that's long-term and I'm making changes that I'm going to judge them over a shorter term period. And so that misalignment causes all kinds of problems with using valuation data. So I think, and we'll get into this later in the podcast, I think valuation data can be very interesting from an expected return standpoint, from a planning standpoint. It can be interesting from all those standpoints, but the standpoint most people use it from, which is look at those charts they just showed me. Time to short the market, time to reduce my equity exposure. The PE ratio is 37 or something, or whatever it is. It's not that useful for that.
Completely agree. I'm going to hold off on some of the financial planning applications for a little bit later on this, but it's about the time frame match of the information that you're using and what worthy signal you think is in that information. There's I believe, a wealth of information, and at least having an approach, a philosophy, an understanding of these things so you can use them, honestly, more than anything in portfolio construction, in rebalancing decisions, in contribution and withdrawal decisions. And that's the kind of stuff we know has an impact on your experienced or your lived sequence of returns over time. I think valuation as a tool, and I'm using valuation in the most broadly sense, not that there's no one metric to rule them all for these things, but having an understanding of what goes into the various numerators and denominators you're going to use for more global decisions can actually make a big difference in your sequence of returns that you actually live and experience over time. I'll take that one with me.
And this stuff can be interesting. Like I don't use it, but I do pay attention to it all the time. Like I look at it, like I'm interested to see what the valuation of the S&P is relative to history. But the problem comes in when you turn it into implementation. And that's where you've got to be really careful is, what am I using this data for? It's great to look at it. It's great to enjoy it. But if it's going to make you panicked because the valuation is ultra high and you're going to make some huge change to your investment strategy, thinking in the next 1 to 3 years, that change is going to benefit me, that's where you get yourself in trouble.
Or, Mr. Value Investor, what about when it's ultra low and you think there's a screaming opportunity? It doesn't always play out the way you think it's going to, even when you see it, right?
Yeah, and it can be. I mean, the scream, like 2009, like most of us at the time felt like that are value investors, that are long-term investors, felt like we did have a screaming opportunity, but we didn't. We probably felt that in November of 2008. That could have gone on for 3 more years before it came back. So it's not that you can't benefit from, if the market's really cheap, you're probably, to be honest, you're probably better off on that side. If you ever were going to make any changes based on valuation, you're probably better off if we have some crazy cheap valuation, adding a little bit of exposure, than you are trying to time it on the other side. Because if I think about like 1995, like 1996, the valuation was getting pretty crazy. 97, it got even more crazy. 98, it was out of control. 99, it was something we've never seen in our lives. Like, how are you going to do anything about that? Like, it's very hard to, if you were reducing your exposure all the way up, you ended up hurting yourself. So it's not that helpful in any case. And I'm not saying you can't, like 2009 was a buying opportunity. Most people thought it was. Even Jim O'Shaughnessy, who's like the most anti-market timing person of all time, wrote an article back then about like a once in a generation or whatever buying opportunity. So it was kind of clear that if I looked forward 10 years, I was probably going to be happy I bought then, but it didn't tell me anything about, well, March 2009 is going to be the bottom. This could have gone into 2010, 2011, and you could have looked like an idiot for a while.
And all this stuff still goes back to what these are good gauges to give you an awareness so long as you can know what's in that numerator and denominator. And especially on the downside, when price is screaming towards what feels like zero, but you still are certain in some way that denominator, whichever composition of denominator you choose, that you say there's some type of durable or at least still alive asset here. Price may be screaming towards zero, but if the value of the companies by some other measurement is not also screaming towards zero, those are the times when I agree on the getting cheaper downside, especially on like catastrophic price moves. That usually has been a lot more of a useful indicator than the late 90s scenario that you just gave, which I was not an investor in yet. But in the seat of high school, where I do remember a history class with the teacher, like talking about trading tech stocks, presumably in the late 90s. I believe he stayed a teacher after that, so I don't think it worked out for him. But
probably not.
But this idea of stuff can just keep getting carried away in each direction. But it's a little bit more banded on the downside, because stuff getting carried away to the downside means we're all dead. Stuff getting carried away to the upside just means there's a new exciting idea that a lot of money's flowing into.
And the other thing we should mention here is there are some arguments now that we talked about how long-term the time frame is where valuation matters. There's arguments now that that's getting longer. There's also arguments right now that doesn't exist, that it doesn't matter at all. I'm not a believer in that, but it is, it's interesting to review that kind of stuff. Like if you look at Mike Green's work about the idea that as more and more people become passive, their money just goes into the market when they fund their 401ks every month. The money goes in the market. They could care less about what the valuation is. We have more and more money flowing into the market that doesn't care about valuation. That may mean valuation-based strategies have to extend their time frame. It also may mean that valuation doesn't matter. So, and we've talked to Ben Hunt about narrative, and there's just a lot of stuff to keep in mind, that there are maybe some more reasons to question whether valuation will work the way it has historically right now. And that's for a different podcast, but I think it's at least important to bring that in, because we do see these valuations in the S&P 500 going up. And if Mike Green's right, I mean, a lot of the driver of that is people that are just investing in their 401ks and are not sitting there evaluating what is the PE ratio of NVIDIA. They're just saying, money hit my account. I need to invest the money. Here's my default option. The money goes in. I'm driving up NVIDIA more. Maybe fundamentals are mattering less in that scenario.
Maybe they do, maybe they don't. Over time, I still am a believer that it's going to help. And people like Mike Green and whatever else can think about this way more artfully than I can. Do you want to talk a little bit more about just calculating the PE ratio of a portfolio? Like, so if you own a bunch of stuff, how that works?
Yeah, well, I'm a big fan, as you know, of the All In podcast, which I admit publicly sometimes. But anyway, like, they always have the science corner in that. And so I think occasionally with these podcasts, we have to have like Jack's Nerd Corner. Because we're taking a little bit of a U-turn here. We're turning maybe a little bit to the left or the right. But I think this is important to bring up, just because people do this wrong so much. Like, people who, let's say Matt has a 10 stock portfolio and Matt wants to figure out what the PE ratio of his portfolio is. What Matt cannot do is take those 10 PE ratios, average them, and say, that is the PE ratio of my portfolio. That is wrong. What you have to do.
But can I call in to a television show and ask if I'm diversified? Is that still okay?
You can do that. Yeah. I mean, I don't have,
but only if I have 5 stocks.
I don't have the red buzzer, unfortunately, that you, maybe we need to get me a buzzer for this. I don't know if we've got budget with the, I don't know if you've been following the budget of the podcast, but, the ad revenue may not be enough for a buzzer at this point, but I would love to have one at some point.
We'll get you that buzzer. So sorry, go on. If I have a 10 stock portfolio, why can't I just take the 10 PEs out of Yahoo Finance on a spreadsheet and just put them in Excel using Microsoft now? I'm using all the good companies and hitting just average.
Yeah. So what you need to do is you need to reverse it. And so what you need to do is you need to take the earnings yield of each position. And so the earnings yield is effectively just the inverse of the PE ratio. So if what you were to do is take the earnings yield of all of your positions, if you were to average those, or if there are different weights, you use the weights in there, and then average that out, that gives you the earnings yield of your portfolio. And then you can invert that final result back into a PE ratio. So again, we don't need to get into all the details about this. I mean, people are going to fall asleep, but it's just important to do that, because people do that all the time. They say, like, here's my holdings. Let's take the average of all those positions. So therefore there's the PE ratio of my portfolio. Even I've seen professional money managers on Twitter who do that, who actually do that calculation with their own portfolio and do it incorrectly. So I think it's just important to have the quick Jack's Nerds Corner to say, this is not the way we do it. And then we can transition back to the body of the podcast.
No, stay nerdy for one more second. So just explain, there's different times. This can be way more awry in certain circumstances than others, where it can actually kind of at least rhyme. Do you want to give an example, or do you have a story about where can you show just how bad this can get if you don't do the inversion? Again, fractions, it's fourth grade math.
But is the big problem.
Right.
It's about earnings contribution, and the outliers are the big problem. So when you end up with the stock with a 300 PE in your portfolio, that's where you're going to end up being really, really wrong. You're right. I mean, if they're all very similar, you might get a similar result. I mean, it's still wrong, but you might at least be in the ballpark of it. But if it's the outliers can really screw this up. So it's just important. And you can go, we won't get into all the details, and you can go to, I think Jake at Economic has a really good blog about this, where he went through the entire explanation of why it works and why you have to do it this way and all that stuff. But it's just a really interesting thing, because I think it's one of those things that most people do get wrong. And even to this day, you'll see people doing this, and it just ends up with a conclusion that's just completely wrong. Now, if market valuation doesn't matter anyway, it doesn't matter. I mean, if I calculate my PE ratio, my portfolio is 60 and it really is 30, oh, well, I can't really do much with that anyway, but it's at least, if you're going to calculate something, you at least want to try to calculate in the correct way.
And this is one of those things where the person telling you the thing and how they're calculating it, if you have an awareness of how this is being constructed and done, then you can at least spot, hopefully, a little bit better if somebody's selling you a bill of goods. Jack, take us now. Let's let's look at individual segments here. We don't have to get super, super narrow into sectors, but let's look at valuations by segment, because this is another thing that I think people who don't look at this stuff regularly get lost in the weeds real fast on this.
Yeah, so this is interesting. So obviously we've looked at the overall market valuation, but there's also ways to look at what is the valuation inside of the market. And you'll see value guys like me do this all the time, which is we operate like with this idea of deciles or quartiles or whatever we want to use, which is we segment out the most expensive stocks in the market and we segment out the cheapest stocks in the market. And then we say, how do those segments valuations compare to what they have been historically? So I can look at just, the cheapest 10% or the cheapest 20% of the market, and I can say, what's the median PE in there? So again, to the point before where we said, you've got the overall market at a certain valuation, you've got your average stock at a certain valuation. You can also have these segments at a very different valuation, and all of those could paint very different pictures. And so what this conclusion is, and you can kind of see this in the chart, is when you start to look at value versus growth, what you find right now is that value is very cheap relative to its history, and growth is very expensive relative to its history. So you can see here, before we saw with this, median type valuation, we saw kind of an average number of 20, which is sort of what it has been since 2005. When you get into value, you're starting to see undervaluation here. You're starting to see stocks have only been cheaper 25% of the time. So you're starting to see a cheaper thing. And we could go through different metrics and show even cheaper things in this. Like if I were to add small cap to this, it would get even cheaper. Small cap value, because size is cheap now too. Small cap value is even cheaper relative to history. But this is this idea of value spreads that you see all of us talk about all the time, which is what is the valuation of the cheapest stocks in the market? What is the valuation of the most expensive stocks in the market? And how do they compare to each other? And that becomes the value spread. So if I switch this to growth now, what you're going to see is the opposite picture. You're going to see growth stocks are very expensive. So that idea of the spread that we talk about all the time is what is the valuation of growth stocks? What is the valuation of value stocks? So if you just looked at overall market valuation, you might miss that because you wouldn't see that spread. That spread just blends into the overall valuation. But for those of us that are looking for opportunities in the market, you can look at that and you can say, what is that opportunity relative to what it has been historically? And we'll talk again about what this actually means, but you can see are value stocks cheap relative to growth stocks relative to history.
It's also fascinating too, because in that, when we split into growth and value, there's a lot of different definitions of growth and value. So understanding which companies are getting lumped into that thing, how they dance back and forth. I mean, I know with the Validia tool, you can actually scrub through a lot of the ETFs and see some of, at least understand some of the holdings data, I believe. Jack, you want to just comment on all the different valuation and methodologies of constructing these indices?
That's really interesting as well. When you think about, I think it's S&P and Russell are the two, right, that have the big growth and value indices, if I've got it right.
Those are the biggest two, I think. Yeah.
Yeah. And when you look at that, like how those are constructed can be very, very different. Like sometimes a stock is either a growth or a value stock. Like they segment them out to one or the other. Sometimes they can be in both. They use completely different calculations in terms of what are the ratios, going back to your point about the denominator before, what are the ratios that determine whether a stock is value or growth? Because one of the interesting things, if you go to just pure academic data that a lot of people get wrong is, well, what's the difference between value and growth in pure academic data? It's valuation. It's not growth. It's not what the earnings are growing at or what the sales are growing at. When an academic tells you about the growth decile, they're talking about expensive stocks. Now, in general, you would expect expensive stocks probably are growing faster than cheap stocks, but it's not done that way directly. And you can kind of see the same thing in the indexes. Like there are some growth metrics in there, but a lot of times a big driver of it is the stock expensive or is the stock cheap? So again, going back to the devil's in the details, it's just always important to look at what's going on in terms of how these things are constructed, because the conclusion can be very, very different.
And not only that, stuff moves. So like Apple is a value stock a handful of years ago and a growth stock again now. Microsoft, a value stock a handful of years ago by many of the classifications, a growth stock again now. As these things shift, and especially because price can often shift a lot faster than especially trailing 12-month data, these names can flip where they are. Depending on what you're doing at a broader level and constructing your portfolios, you're thinking about this stuff, that can be a little bit of a head spin. So for those who choose to slice and dice and think about things on these terms, understanding, again, the composition of those numerators and denominators can go a really, really long way.
And it's also, as companies mature, they change. So a lot of people like associate technology, growth, expensive, but a lot of these technology companies, now there's cutting edge technology companies that are way on the growth spectrum. But a lot of these big names, the Metas of the world that we've gotten to know, have over time, and maybe not as much because they've had big runs recently, but have over time shifted more towards the value area, because those are big, mature companies that are growing at more normal rates now, and they're going to trade at more reasonable valuations. So it's whenever you see a company that you've kind of grown up knowing, like Meta or something like that, you want to refer to it, you want to think of it as a certain type of company. Like Meta is a growth company, but all growth companies over time typically will migrate towards value, because just as they get bigger and bigger, it just becomes hard to grow at those kind of rates.
And again, the point you just made 2 points ago about a growth company has a growth valuation, it doesn't actually mean it's just growing. So as companies get bigger, the ability to grow an increasingly larger ship is just definitionally harder. Just simple as that. Doesn't mean they can't still have big price swings when they crack a new market or they crack a new idea or something that rewards them.
The one other place you can really use this and learn from this is when you compare countries. So for instance, we'll all talk about how emerging market stocks are cheap, and they are cheap. But the one thing you have to keep in mind is you have to think about sector composition. And this is, again, the devil's in the details. Like the US market has a lot of technology, like rapidly growing technology companies. Emerging markets are much more resource and, cheaper type stocks heavy. So if I don't correct for that difference, they're going to seem way cheaper than they actually are relative to the US. So now, even when you correct for the difference, they're still cheap. But the point is, you'll see these crazy things talking about how, the US is the 1% most expensive it's ever been relative to emerging markets. That might be true, but you want to make those adjustments first. You want to say, what type of sector composition am I looking at in emerging markets? What type of sector composition am I looking at in the United States? Let's normalize that. And then let's do a comparison and say, are they really still cheap?
Yeah. If you start saying this is cheap relative to that, but forget to say, well, these are a bunch of poorly run banks and energy companies, you're never going to make apples to apples comparisons here, but just making sure you're at least doing like apples to oranges and understanding your comparisons, especially when using valuation across stocks, very, very much worth the step to understanding what you're buying. Otherwise, you could find yourself on a purely valuation driven argument saying, well, why isn't everything in this other part of the world that's so attractively valued? And if the reality is because it's a bunch of really crappy mining companies or something, you can find those in your home country sometimes too. Or even you should have a reason where you want to go.
Or even like the state-owned enterprises, like those things are always messy. Like, Russia was very, very cheap. Russia was like dirt cheap before the entire thing collapsed. So it's just important to understand what you're getting inside of that valuation. It's not like you can just take Russia's valuation and compare it to the US and be like, it trades at 5 times earnings and the US trades at 30. So therefore Russia is a very attractive. There's a lot of more details that go in there, both in terms of the risks in the countries, but also the composition of the index and what you're actually getting in terms of the companies. Like another interesting example is like Korea. It's like Samsung is a massive part. I don't know what the actual number is now, but like of those Korean indexes, like Samsung is a huge, huge part. So that's another example of what you've got to look at. Like one company, and we've got concentration in the US, like it's nothing compared to what some other places have. So you just got to be looking at what you're getting and understanding that when you evaluate any kind of valuation data.
What happens when we step back and we don't just look at stocks, but we look at stocks relative to bonds, for example, and apply valuations? How do you think about that as a quant?
It's just always important to think about there is a trade-off there between stocks and bonds. Like Bob Elliott had a really interesting tweet the other day where it was like stocks went down slightly, but they got more expensive. And the reason they got more expensive is because bond valuations, or bond yields had gone up. So it's just always important to think there is a trade-off, like between long-term bonds, short-term bonds, stocks, all of that stuff. There's a trade-off that exists. And, when you're investing in stocks, you have to consider that trade-off. Obviously, if I could get 15% on a short-term bond, which I can't right now, but let's say I could, that changes my view of whether I should be investing in stocks. And so that again is another point to keep in mind. Like all these charts we've shown so far, they don't consider bonds as an alternative to stocks, but it is important to at least keep that in mind and to at least understand that's out there. And, the earnings yield of stocks relative to the yields of bonds, you can show some charts around that. And that's always interesting to compare. And sometimes when you see something in the types of valuation data we showed first, like the valuation of stocks, when you put that bond data in there as well, it helps to explain it a little bit more than maybe just having the stock data on its own.
Cross asset class valuations are, I'll make myself save it for just another topic that we'll get to, I'm sure, in a minute. They're useful to understand what valuation metrics, which numerators and denominators you're going to use both within an asset class or within a sector or within a portfolio or whatever it is where I'm comparing businesses to other businesses in some way. You want to know what's in the numerator and denominators there. Same thing when you're looking at bonds. Bob Elliott example stands. Like, you can look at stuff relative to other bonds, relative to itself to make sense inside of that asset class. As soon as you start to compare across asset classes, you're going to need some extra math. You're going to need some extra thought to understand how these things act together, and then what you're even going to do with this information. Because if you think one thing is rich and one thing is cheap, it doesn't necessarily mean that it's cheap and rich relative to each other, or just cheap and rich inside of that silo, or if you should rebalance, or if you should hold off because this historically happens every so often. There's a lot of nuance there. Useful to understand how to do it, but what you're going to do with that information becomes, I think, even more critical in that perspective.
That's kind of become the theme of this episode, which is all of this stuff, is all interesting to look at, but like what you do with it is so important. And if you try to do short-term things with it, typically it's going to go against you. Or if it goes for you, you're going to be lucky. And that's, again, the idea of you just have to know what is like the time frame of this signal, and then what is the time frame of what I'm trying to do with changes to my portfolio, and do they match up? That's an important question to ask no matter what, I think.
So we're getting closer to the financial planning aspects of this that I'll weigh in on some of, but let's talk about the link between valuation and expected returns, because I think this wraps us back around to that time horizon bit you mentioned a couple of times so far. What's the link between valuations and expected returns?
Yeah, so there's other components of expected returns, but one of the components, when you see, Research Affiliates has a good site that does it, other places do it. When people calculate these expected returns, they typically, one of the components of that is valuation. And what they're assuming is basically the market has had some sort of valuation over time. When the market is expensive relative to that valuation, they're assuming it's going to come back towards that. When it's cheap, they're assuming it's going to come back up towards it too. So when the market is expensive, you're assuming expected returns are going to fall because that's going to be a drag. Moving back to sort of a more normal valuation is going to be a drag. And when it's cheap, it works in the opposite direction. And so you'll typically see, like, I think Research Affiliates, I think it's like 7 to 10 years. I think that's around where they do expected returns. So again, going back to what we talked to before, like this is useless for 1 year, 2 years, 3 years, but over 7 to 10 years, they decide how is that valuation going to impact the expected return of not just the market, but they'll do it, in all kinds of emerging market stocks, value stocks, all kinds of different things, different asset classes. And so in stocks specifically, it's just important to keep that in mind, because what happens is valuation is a component of those expected returns. And it can lead to, like right now, I think they're showing, like for US stocks, a very poor expected return. Now, for value stocks, they're showing a better return, back to the point we talked about before, where value stocks are cheap. For emerging market stocks, they're showing an even better return, back to the point we talked about before, emerging market stocks are cheap. But so these can be a valuable tool in terms of just thinking about how the future might play out. But it's also important to keep in mind, these are wrong a lot of times as well. Even at 7 to 10 years, a lot of times this valuation does not revert in the way you think it's going to revert. I mean, if you think about that first chart I showed you, where we were talking about the market valuation, like for the first entire half, I don't know what that was, back to almost 1900, I think. Like the first half of that chart had a certain average valuation. The second half of that chart had a certain valuation that's much higher than the first half. If we had sat there expecting that to revert for over 7 to 10 years, over and over and over again, we would have been wrong over and over and over again. So, and this is a big issue these guys deal with, and we talked to Rob Arnott about this when we interviewed him, is like, what do you expect it to revert back to? Well, we've got this valuation that's the long-term valuation. We've got this valuation of the past 30, 40 years. What do you do? And what a lot of people do is they kind of split the difference. They say, well, we're not sure, if valuations are going to stay at this higher level that they've been in the past 30 or 40 years, or if they're going to go back to this lower level. So let's kind of assume they're going to they're going to revert to somewhere in the middle. But all of that plays a big role in these expected return calculations. So that was kind of a long answer, but expected returns can be interesting in terms of if I'm trying to figure out like what might happen in the next 7 to 10 years with stocks. And if I'm in an extreme situation where they're very cheap or they're very expensive, that can go into what you do. That can impact my financial plan. That can impact how I think about what the market might deliver me over the next decade.
Tools like the Research Affiliates tool tools like others and just understanding the math. It's a funny thing, but like 10 plus years ago, I think John Hussman was the one who actually wrote a series of posts walking through the expected returns based on assumptions math. And it was an incredibly informative experience for me to like work through all the math and build some spreadsheets that did this stuff because it is maybe I'm misusing the word. It's a mean reverting set. It's one of those things where it's like valuations do tend to have some impact on if you're average, above average, or below average in the years that go forward, usually somewhere between probably like 5 and 12 years. I think it's 7 to 10 on the research affiliate stuff. Where it gets really interesting is when you start to scale these things, and this is the financial planning aspect. We want to know what those forward return assumptions are looking forward in time with some type of valuation adjustment to the point you just made. We want to know, are US large cap stocks rich or cheap relative to history? And what's that assumption look like going forward so that we can make a comparison against US smaller mid-cap stocks, the real estate stocks, infrastructure companies, inside the US, outside the US, big and small, inside the US, outside the US, across the fixed income complex, across various types of adjusted for their valuation metrics, private equity, private credit, private real estate, things like this too. The assumptions, when we start to stack them up next to each other, then we start to think, how can I rebalance between one or another if somebody is adding or taking money out? Because that's definitively a rebalancing scenario, not just like the portfolio exists and I'm rebalancing, but contributions and withdrawals, what's attractive, what's not, and why over the horizon the person may need it for consumption or gifts. And especially as we start to look over longer time horizons, we want to be thinking about how does this play into everything from like estate planning to future consumption needs for years and years down the road. So when we think about that, are stocks rich right now? So if you're 25 years old and you're not even thinking about retirement, should you have money in stocks just because they're rich? If you're contributing money to your 401k, you probably want that variance. You want to be on the right side of this thing, even though your current expected returns are low. You're trying to build up that nest egg in this category, and you might overlook a bunch of these things. If you're 65 and you're trying to plan for something, if you're the 70-something-year-old client I was talking to this morning, where we're paying for in-home healthcare and stuff like that, we have to approach these assumptions with a lot of granularity. We have to think, okay, mom still has these stock accounts, equity valuations are up, we need this money for consumption. This is probably a good time to take certain things off the table. We just have to calculate taxes and all the other stuff that goes into the mix. Always pay your taxes, folks. This idea of understanding how to look cross asset classes and having a methodology for money as it's added or taken out or let to ride, that's a hugely, hugely important aspect of the financial planning process. And it's hugely personal for anybody in their portfolio.
How do you think about this, like in terms of the overall market? Because it's interesting. Like if I let's say I've just got somebody who's just invested in the S&P 500 and I have to figure out like, what are my return assumptions going forward? Like I could go about that in different ways. I could say, the S&P 500 has delivered 10% or whatever it is over the long term, and that's my return assumption. Or I could say, I could go to research affiliate site and I could say, they're expecting 2% returns, so I need to make some adjustment. I mean, I would assume one thing that I think is important to keep in mind is like research affiliates is doing a 7 to 10 year assumption. As you lengthen that time frame, you probably get closer to the market average return. So if that's 30 years, I'm going to be a lot closer to the market return. And a lot of people probably are planning for a 30-year retirement. So they probably don't want to get too wrapped up in this 2% 7 to 10 year projection, because over time, that's going to at least blend in a little bit. But how do you think about that?
So there's an interesting background component to this for me, and that's having done a lot of work in like building pension type portfolios. So liability driven investing mainly, where you're looking at these shorter time horizons. So if you're looking at a 3 to 5 year or a 3 to 7 year window in many cases, doing like liability driven investing, getting ready for money that'll be needed to be paid out to pensioners or whatever else, those tools, like what research affiliates and people like that are building, are actually really useful for those circumstances, because you're trying to figure out, how do I get to my 4% bogey or my 5% bogey or whatever it is, my hurdle rate for this pension that I got to hit over this finite period. For most people who have like a 10+ year time horizon on this stuff, it's a different approach. So let's just separate this to be ultra clear about it. If you are doing liability-driven investing and trying to fund some very specific goal in a sub 10-year period, you might want to think about it through the lens that Research Affiliates describes. If I have an extreme overvaluation, I might actually look at that forward return at 2% on stocks, say I can instead lock that in fixed income for my 5-year period that I need. And that might be the decision and all the math that I need to go, don't need to own stocks in this. I can accomplish this thing with bonds based on the valuation assessment. It's just really not worth the risk at all. From a pure shorter term, sub 10-year liability driven investing standpoint, that's really useful to know the math in those ways. Now, if I'm planning for a regular client, or especially when we get into the multi-generational conversations, we have to do what you just said. We have to actually say the long-term assumptions for stocks, making the number up. If it's 10%, but I know stocks, U.S. large cap growth stocks or U.S. large cap stocks are now a few shades above average in how they're valued, I might not want to use 10% anymore for that number. And we have a bunch of people who do a bunch of math about this and go, we are in an overvalued historically environment. So instead of using the 10% number, maybe we're going to duck that down to 8% or 7% on the look forward for 10+ year horizons. And we want that because now we can start to compare it to other asset classes, the expected correlation between those asset classes, and the timing of future potential liabilities in that individual's plan. So shorter term liability driven investing, just trying to make sure we match up assets. These valuation tools can be really useful in what to hold and what to avoid. Over a longer term, you can usually use the long-term assumptions, but you're going to duck, tilt, whatever word you want to use, in the direction informed somewhat by the valuations, where they stand against history. And if you want to raise a little bit of caution, usually for new money coming in, new money coming out. So I have a 20-year time horizon. I'm not so worried about money coming into stocks relative to bonds. Because of that time horizon, I can take the variance. If I have a shorter time horizon, I might be going, okay, with that new money coming in, because stocks are so richly valued, I might be looking at another piece of fixed income or making sure I invest more in small caps or something else, because that marries itself better to the time horizon and the goal profile that I have. Did that make sense?
Yeah, it did. And that's great because it kind of gets at the point we've been talking about the whole time, is like all these tools, the tool is great, the information is great. What I do with it is the most important thing. And you just gave a great example of how these expected returns, there's not one way to use these expected returns. They may or may not be relevant depending on what you're doing. They may be a lot more relevant, like you said, if you have a shorter term time frame and you have a given, liabilities you have to meet. They may be a lot less relevant if you're retiring tomorrow and you have a life expectancy of 30 years. They're going to be a lot less relevant. You shouldn't be like completely panicked about the 2%, return. I don't know if it actually is 2%. I just made that up. I know it's significantly lower than what
it's like 4% or less though.
Whatever it is. It's not good. So it's just interesting. Like a different person with a different time frame with different liabilities in the future is going to think about these things in different ways. And I think that's probably the most important thing to take away from this is, look at the data, but also understand how is it relevant to me and how is it relevant to what I'm doing. And that might be very different than how it's relevant to someone else and what they're doing.
And in many cases, in the real world financial planning cases around this stuff, most people have a mix too. So you have a mix and you're going to go through different periods. So post financial crisis, you had all this pension reform happen. You had a giant movement for business owners. And this is if I just think about the last, call it 12, 15 years here on this stuff. You have this giant pension reform post-financial crisis, a bunch of business owners. All of a sudden, it makes sense to not just have the 401k set up with the full profit sharing, but to bolt on these cash balance pension plans for extra tax deferral, depending on their time horizon. You were in a 0% world with like a 4% hurdle rate on these cash balance pension plans. So you had to do this liability-driven investing thing inside of a place where you couldn't really use fixed income to get to your bogeys that started to shift as interest rates shift. Now, as those things shift, then we have the Tax Cuts and Jobs Act, which now all of a sudden, a lot of those same business owners are doing the consideration, do I keep this in place and do I convert myself to an S corporation? Again, all the tax planning around what gets consumed, what doesn't, what gets deferred, what gets paid out later, how are we going to treat these things? Then we have COVID and small business valuations go through the roof. My point is, you could have a business owner that's lived through like 16 different eras with 16 different asset classes and 16 different crazy assumptions that have changed wildly in this period of time. And that's just like in one client's life, they might have experienced all those things. These tools are useful. And I'll go so far as to say, like, having a approach is actually essential. You want an advisor who can walk you through the different approaches that apply what, where, when, and how. But then that why, taking it back to what you're trying to achieve and how you want to do it, like, that's all that's actually going to matter here. You have some logic to steer all this stuff through, because it matters a heck of a lot more than the gap between US large cap, growth, value, or at the index level. That, I think, that's the ultimate concept behind this whole conversation.
Yeah, I think that's great. And that's what you do a great job of in these. Like, again, we ended up connecting this to like a certain person's why in terms of what they're trying to do. And it's so we've looked at so many charts and valuations and stuff, but bringing it back to that is important because that's ultimately what matters. Is for every person, how do I use this in terms of trying to achieve what I'm actually trying to achieve? And when you do that, you'll find most of this stuff we've talked about today, most of this valuation data doesn't have that much impact, but it can be important to understand it. And especially when we got to the expected returns part at the end, like it does tell me a little bit about where we are as with the market and what I might expect, coming forward in the next 7 to 10 years. And that can be valuable for people just to understand that, even if I'm not going to make changes to my portfolio tomorrow because of it.
These are snapshots for points in time. They're worth understanding. I'm thinking about like movie soundtracks, 90s movie soundtracks, lots of great 90s movie soundtracks. The Long Road, the excellent Eddie Vedder song that appears on Dead Man Walking. Crazy, crazy soundtrack, crazy movie. Susan Sarandon, who would have known it? Rocky Horror to Dead Man Walking, like all that stuff. Sean Penn, same thing. Sean Penn in prison, lots of great Sean Penn prison movies. But here we have, I think it was like, you had Tom Waits, you had, you have Eddie Vedder breaking out from Pearl Jam on the solo career. You have this fascinating stuff that happens for a brief moment in time. Valuations, kind of like 90s movie soundtracks. And if there are even movie soundtracks anymore today, I don't even think I know. I think TV shows have more soundtracks than movies, or at least playlists. But it's just, they give you a measurement of a point in time. You got to figure out what you're going to do with it. Beyond that, it's entertainment.
Well, I'm happy you brought in the pop culture reference because I can't wrap up the episode, as you know, until you did. So I could have rambled on for another hour.
I would feel morally wrong if I didn't at least try to tie this back into, our Lord and Savior, Eddie Vedder.
The viewers, thank you, because I was about to break up some more charts. You prevented them from having to do that. So, but thank you everybody for joining us, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.